This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Patrick Lynch and Scott Langham with Whitestone Wealth Management to talk about something that, honestly, I'd never even really kind of thought of as an investing strategy or philosophy besides just kind of what you hear occasionally in the news, and that's endowments. I think everyone hears of like the Harvard Endowment or Yale or Stanford, and understanding that that's just a pooled block of cash of sizable amounts that we could never imagine that is used to support these organizations. But, you know, the thought of like what actually goes into that or how that could kind of actually even be applicable to you as an individual investor is something I had certainly never crossed my mind. I can say a few things in my investing career with certainty, and I can say for certain that is not one that had ever kind of come across my desk as something to think about. So again, very pleased to have you both on. As always, I do like to ask our guests to give a little bit of a background about each of you, how you kind of came to be in your current position and franchise within the business, and then we'll dig into the topic at hand.
Okay, great. I'll go first. I'm Patrick Lynch. I was introduced to this business and began in this business 1981. So I've been in it quite a while. I've seen a number of changes, and basically I was brought up on something called modern portfolio theory. And modern portfolio theory was a concept created by a guy named Harry Markowitz out of the University of Chicago. Markowitz, a brilliant guy, won a Nobel Prize for his work. I looked at it, I studied it, I became very proficient in trying to make it work for our clients. But one thing I noticed is that when we had major corrections, there was nothing spared. And unfortunately, it looks if you look at the tickers today, you'll see some very similar things going on in the market. So I basically became a little disenchanted with modern portfolio theory, and came across a book called Endowment Style Portfolio Management. And started working in this. In endowment style portfolio, these big universities, big charitable organizations, they can be reduced down to something very similar to a household. It's just bigger and more zeros. But there isn't a penny's worth of difference between the two concepts. Endowment style for Harvard University, or endowment style for Mr. and Mrs. Smith who are retiring. And so basically I tried to bring this to bear on the clients that I had, wanted to make it more technical, and I wanted more predictable results. And we started to do this. We created a correlation matrix, which basically just says, all right, fine, I don't want everything I own going up at the same time. Well, why not? Well, because everything you own will go down at the same time. So we want to have assets that are a little out of phase with each other. We don't want everything running along a sine wave. So we worked at that. I met Scott in around 2003, 2004. Scott was able to bring a lot more of the technical computer spreadsheet information that I basically was not that proficient at. And Scott really helped me take this thing to a new level, helped us take it to a new level, and that's where we are today.
No, yeah, absolutely. I'm a big proponent of non-correlation in assets. It's something that I spoke about on this podcast. Not something that I try to practice as well, is achieving true non-correlation between markets and assets. And always makes me excited when people mention it.
Yeah, what we're trying to do is we're trying to get some handle on systematic risk, and that's whole market risk, and we believe that the endowment style portfolio really lends itself in a robust manner to this type of portfolio.
Awesome.
Go ahead, Scotty. I'm sorry.
Yeah, no, like Pat said, we met up around 2003. I was kind of new to the business. Uh, I came into the business through the brokerage world. I, interned with Merrill Lynch, and my first job was with Morgan Stanley, and it was just calling people, trying to get appointments, everything like that. When I joined Pat and Steve, it was much more planning based, much more around, not just having a portfolio of stocks, bonds, and cash. And at the time we met, Pat was really trying to build out the alternative allocation, which was hard back in those days. There wasn't as many alternative assets available. We kind of had to search for certain mutual funds or closed-end funds that were doing unique things within the regular scope of a mutual fund. So it was a lot more difficult back then. But at the time, Pat was really looking at a systematic way to evaluate managers against their peers during poor market performances. And he was kind of doing it just looking at certain dates. And, Pat mentioned bringing Excel in. I just said, man, we could build something in Excel that's going to look at a lot more different dates. So we can pick anything we want instead of having to search out all this information manually. And the goal was really to build something that gave you information that you're not going to be able to get off of Morningstar or Zacks or Yahoo or something like that, and tease out more specifics about performance during bad periods. And what you learn really quickly, if you really do like a peer analysis of what different mutual funds do during risk periods, you start to realize that there are certain mutual funds that do something a little bit differently. And it's that they have a process that's based around risk management, where I think most mutual funds and ETFs that people buy today have a methodology, but it revolves around trying to get the best growth prospects for a 10-year portfolio. They're not choosing managers or their investments based on their risk management process a lot of times. And so,
yeah, it makes a lot of sense. And it's a good point to bring up of the, look at what the successful people are doing when times are bad philosophy, which I think too often than not, we try to look for the smartest person in the room when everything's going great to see, hey, that's great, because even rarely do people do exceedingly well in bad times, but you always want to see the people that are, doing something to an exceeding standard. So my question to both of you though is, we've kind of teased around, the word endowment of, hey, like, how does this work? But, from a general perspective, when you say endowment investing, let's get a little bit more kind of like a base level definition of that, because even being, a financial professional for 13 years and also being in the alt space for just as long, I am equally curious. And, it's just not something that really comes across my desk. So let's kind of define the parameters of kind of what we're talking about when we mention endowments, and at a base level.
yeah, at a base level, I'd say majority of people's portfolios are stocks, bonds, and cash, especially when you get to the retail world.
Mhm.
Our interpretation of the endowment portfolio is just way more asset classes than just stocks, bonds, and cash, and different types within those universes. So you can't just look at public stocks as your equity allocation. You need to look at private equity as well. Public markets are shrinking, right? The same goes for credit. You have public credit and you have private credit. You have secured credit that comes with collateral. These are all different types of credit that you should have in your portfolio. It also extends into real estate, right? Into commodities portfolios. Managers who are doing hedged products, who might have a little bit of everything, but they're going to change around the portfolio based on what's going on in the macro environment. There's also insurance products. I hate to just say annuities, but there's all kinds of products that you could use. Using variable universal life. There's some very interesting index annuities and RILA products that are coming out that are worth looking at, even for a client who says, I hate annuities, right? And so it's not. Endowment is really more about having true diversification amongst several asset classes, not just stocks and bonds.
No, it's definitely a great point. And so what we're talking about more is kind of like a conceptual, like, like pathway to follow, not necessarily like a prescribed method, right? Like, and is it something that y'all package together as, again, more of kind of like an advisory role to people, or is it something you package more together in kind of like an investable fund, or both?
more of an advisory role. I mean, where we really start is, I think what sets us apart is we base everything based off of a cash flow procedure, right? Where most places that you go to, they're going to give you a questionnaire that says, how old are you? When are you going to retire? Which of these four choices would you pick? And then they give you a score, and then that gets you to a risk tolerance level, right? And then they say you're moderately aggressive, so you're going to go into this portfolio C for moderately aggressive people. Our methodology is that your portfolio should be allocated according to when the capital needs to be spent in your cash flow, right? And so every little thing that you invest in deserves its own timeline. And so the cash flow really controls, in essence, we have risk categories to say there's money that we need very soon that we don't want to take risk with. That should be in things like short-term bonds or CDs or anything that doesn't carry a lot of risk. Then there's money that we don't need now, but we will need very soon. We can take a little bit more risk with that. That brings in a new category of investments, right, that provide income, but also might benefit from being invested over a 5 to 10 year period. And then you have money that you're not going to need until much later. And that's where you should put your aggressive investments, right? Like stocks and passive things like, if you're just going to be in the market, right? That should be in a portfolio where you're not supposed to access it for maybe 15 or 20 years. Yeah. And so we end up categorizing asset classes by how much risk there is. And then based on what their cash flow tells us, kind of helps us invest and allocate that client's money according to their cash flow, not according to their interpretation of risk versus our interpretation of risk.
Yeah, one of the key things in what Scott said is that all of the assets that we're considering are tied to a time period. Okay, so we don't need liquidity in the area that we're saving for 10 years from now. We don't need immediate liquidity there. And that allows us to have growth in that position, while the shorter positions allow us to provide income mixed with growth. And so if we attach the correct time period with each asset class, then what you're constructing is sort of a perpetual machine. And this perpetual machine should continue to go without much oversight, although we meet with our clients very regularly, and to see if there's any difference. Do they need more income? Do they need a lump sum of money? What do they need, etc.? So that's the endowment style portfolio and how we begin constructing it. What we are looking for in all of these things are the best managers we can find. And I think, Alex, you said a minute ago, we all want to, the best manager in a great market doesn't tell me anything. The best manager in the bad market tells me a lot. And that's about 5% of all managers out there. So that's who we are trying to filter, is find the managers that have a process, use the process, and the process protects the portfolio.
Those are all, there's definitely a lot to unpack there. And where I think I kind of want to start is the asset variance. I think that's kind of the interesting part about what you're talking about, because with the traditional style of investing, again, it's all basically centric to what is on the market. And then if you want to get outside of that, there's kind of like a few other buckets. Either you can be like, okay, I'm in the insurance world with annuities and whole life and universal and everything like that, or you can just go fully into the alternative space that we operate in, where it's like, hey, let me do limited partnerships, private stock, debt, all that kind of stuff. There's really not much of a blending, if you will, kind of, I think, in the traditional advisory roles, for a few reasons. I mean, we did have fiduciary law changes back in 2018, which made a lot of the more the people sitting at desk at Merrill and Raymond James a lot more risk averse to anything that's not just registered with FINRA. But what I would be really interested in kind of pick your brains on a little bit more is that when looking outside of, again, just the standard securities market, what are some more, at least maybe kind of anecdotally, for what y'all have discovered and developed over your experience, has been more of kind of the surprising areas that have performed well that you feel are kind of worth looking at when looking at this style of investing? Is it, the private equity? Is it the public and private credit? Is it, limited partnerships? Is it, whatever it is? What are some of those kind of more things that you find to be a little bit more interesting from your perspective that have, fit into your matrix?
Yeah, to us, I think it's people who have a process for doing something. It doesn't necessarily have to be, I think of some companies now aren't as much real estate investors, like buy and hold investors, as they are opportunists about, hey, maybe we can reshuffle this property and make it something else, almost in terms of development, right? That's something I think that's very new to us, and people are getting access to. Is before it was, if you wanted private equity, you're in a deal for 10 years or something or 20 years plus with Goldman Sachs, and you don't really know what's in there. It's kind of a black box. And now companies are bringing products to the forefront that allow people to get into those types of vehicles in a more liquid way, right? You have interval funds and tender funds, things like that. And so we really hang our hat on the process that somebody uses to do it. So if it's an oil and gas program, it's not that it's oil and gas. It's that they figured out a way to make it a shorter time hold and have a more efficient cash flow. And it's a way of carving a certain process out of that asset class to make it better. The same thing occurs in real estate, right? Instead of just saying, I want exposure to real estate and I'm going to hold a diversified portfolio, we are much more likely to go after a very specific sector like industrial distribution or self-storage, and have a process carved out that's meant to be a repeatable process that they can do over and over and over again. That's what really drives our decisions to go into alts. We're not going to go into an alt just because it's an alt. We have to have a process involved that makes it better than just that asset class.
Yeah, that's a real interesting point that you make, that I think from most of the people that I've talked to kind of that are more in the advisory role don't, and again, not, there's certainly, if you can make money and you provide, proper protections for clients, is not bad, but it's definitely interesting to look at it from this perspective, that you're not necessarily looking at this asset per se. I mean, obviously that's important, but it's the operator that you're really kind of focusing a lot more on, whether it's the efficiency gains or just the stewardship that they offer in a particular asset class. So my next question really would be, what are some of the quantifiable, like, how do you figure that out? I mean, it's, I could be in oil and gas and I can tell you, say, hey, look, I figured out how to frack, the middle of this place. It's awesome. It's great. It produces X, Y, and Z, and it's all this great stuff. But it seems like you're investing a lot more on the person than the end use case. So how do you quantify that?
Let me take the first part of that, Scott, and then I'll turn it over to you. You're exactly right, Alex. I mean, we're looking at the person, and what if we can find let's just say, for an example's sake, let's say we have a mutual fund, and the mutual fund is advertising a 10-year rate of return of 11.1% average. Okay, and that sounds great. 10-year rate of return, 11.1% average annual return, checks all the boxes. So you end up, reading, how much can I put in? What is this? What's the beta on this fund? What's the alpha, et cetera? But what you will eventually find out is the lead manager has been there 2 years. The guy or woman that created this great return is gone. So that is completely taken off the table for us. We are looking for the person and tying that person to the process. And if that person, I don't care if they're the chief executive and maybe it's a private equity program, you still want to find out everything you can about the process that they use to protect clients, and to grow assets. So Scott has created something where the managers cannot hide. They cannot hide between risk periods, and they certainly can't hide behind any type of turnover in their management. So go ahead, Scott, and dig down into
Really answer the basis of your question is really you have to look at the track record. You have to hold them accountable to their past performance. Even if somebody comes to us and they say, we've got this great process and the process looks bulletproof. Okay, well, what have been your results over the last 5 years? Well, we don't have any results. This is a new program. Then it's an automatic no. I mean, we'll definitely look, but if you don't have an actual track record, it's difficult. And what Pat's talking about, it's easier to evaluate publicly traded investments, right? It's easy to put it up next to each other on a graph and you can see every single day's pricing. You can calculate all the drawdowns and everything. It becomes much more difficult when you're talking about the alt space to say, hey, let's look at this specific real estate program.
Yeah.
They have to have past deals. Typically, like you said, we're looking at limited partnerships, companies that have been executing the same strategy for a period of time. We don't like it when it's, XYZ Fund 1, right? That's difficult to say, oh, you've done this many times. It's easier when it's Fund 7 or Fund 11 or Fund 20, something like that.
until you find out that Fund 7 is their first fund.
Yeah.
It's like Fund 18.
Yeah.
But it's,
That's right.
it's, you bring up a good point too. And also to the point, I think a lot of people that really, are amenable to alts are people that are probably in one of the underlying industry that has them around it. Your real estate professionals, your oil and gas, your energy people. And, from my perspective, I feel comfortable. I've read, actually, I really wish I knew the number of PPMs for commercial real estate syndications and other real estate ventures I've read over my career. If it's less than 200, I'd be blown away. But I feel comfortable myself. Again, I'm not licensed to do it for a client, so I wouldn't do that. But me myself personally, I could, with a high degree of accuracy, can go in and look at this and sift through what smells funny and kind of find a good one. But from that same perspective on alt, you send me a prospectus for an oil and gas play, I have no idea what I'm looking at. I know there's a real estate component. I'm like, well, do you own the land? What are the encumbrances? I pass that, I have nothing to ask. So having that kind of systems, what I'm trying to tie this back into is that having those systems that can, identify and qualify the operators from a higher level is something that I think is important. One, because I am fully in agreement with you. Anytime that someone asks me about real estate, which is where most of my expertise lies, is I tell them look at the operators. They're the ones that you are going to be stewarding your capital. You're going to fork over a $50, $100, $250,000 check to them. Make sure they know what they're doing. At a high level, you want to make sure that, hey, have you done this before? And even certain industries are harder to peg too, right? Again, harping on real estate, but it's been almost impossible to do something that would fundamentally fail in commercial real estate starting in 2016, 17 up until maybe 2022. You could have been doing this for a long time and had a great track record. So the cracks aren't going to show in your philosophy until interest rates go through the roof, your cap rates start getting compressed, and you can't refi at anything that's not going to have to involve either preferred equity or a bridge loan, right? So,
Yep.
It's tough from that perspective. So when it comes to that, maybe share a few of kind of the things that, besides just a track record, right? Are there any other intangibles that you really look for when identifying and qualifying operators? Because again, track records are great, but sometimes the market's been so good that you haven't had to, you haven't had a nice, a nice brush fire to clean everything out.
Yep.
The undergrowth.
Yeah, exactly.
The first one is the easiest one. The biggest one is, are you invested in this yourself? Right? Are the managers invested in their own product?
Skin in the game.
Skin in the game is a massive deal, and we take that seriously as well. Before we do any of these programs or LPs that we're talking about, typically Pat or Steve or myself buys a portion of it for themselves as well. We want to understand it, make sure it's right for us. If it's right for us, then maybe it's right for our clients.
Yeah.
Right? We have to have a litmus test of how much confidence you have in this program. And if your own money is in it, the confidence goes up quite a bit from there.
Yeah, no, absolutely. I think that's kind of a key. And then, from a few different perspectives, again, the how broad do you think is broad enough, right? I think that when it comes to this perspective, what I'm really hearing from both of you is that you're aiming for, again, a very non-correlated investment portfolio between one, markets and assets, right? So, you can be extremely broad, but how focused do people really need to be in this concept of endowment investing?
I think it
Well,
depends on the asset class. Sorry to interrupt. Go ahead, Pat.
well, I was going to say you start off with the foundational investments, and that's like you're building a house, so they're going to pour the concrete for the foundation today, okay? And it can't rain. It has to be above 40 degrees Fahrenheit. All these things have to be in place. Then you pour the foundation. No matter how it looks, nobody ever gets an award for the foundation. It's not pretty. It's not attractive. It's a hunk of concrete. It doesn't. It's not sexy. So our foundation, our hunk of concrete, is what Scott said are the assets that will deliver immediate income, assuming this client needs income starting next month. And so we need to deliver the check in the mailbox, and we need to also have all the other assets growing properly. I think, Alex, the one thing you're saying is about allocation. What is the percentages? Why do we assign percentages of these different assets? And that's all based on the cash flow analysis telling us in a certain inflationary environment, how much money do we need to have in each one of these phases? Phase one, money I need now. Phase two and three, money I'll need soon. And phase four, money I'll need much later. And so each one of those, by definition, assets, that these four assets fit in money I need now. These seven assets fit in money I'll need soon. And then other assets fit in money I need later. Okay. So that's what designs our allocation. The cash flow really drives everything for us.
Oh, that's interesting because cash flow is something, again, that's near and dear to my heart. And again, a lot of what we do professionally on the alternative asset custodial side at Advanta IRA, it's a very big component of what almost everyone is really aiming for. A lot of the things that people invest in here, they're investing more price point agnostic to it. People are doing the individual investments, maybe not necessarily a portfolio kind of thing, but they're a little bit more, again, not putting so much weight on the price point. It's really what the time horizon is for the cash flow needs, and appreciation is just the icing on the cake, right?
Exactly.
If you can, if you have $1 million worth of, if you have $100,000 worth of assets that cash flows that perfectly covers all of your bills and leaves you enough left over, does it need to be worth $1 million? Well, it'd be nice, but you have no need for that. And that's something that I found throughout my career that, coming out of college, with business and finance, I'm like, great, we just need to have everything continue to do just a hockey stick up to the right and value. But in reality, it's your immediate needs, right? Something can be worth $1 billion, but if you can't sell it, that's great, awesome. It doesn't really do you any good. So how was it what was the pathway that kind of led you to putting so much weight on cash flow? Was it something that you initially started out with and said, hey, look, this is where we're really pegging everything? Or was it more of kind of a slow build to say, like, hey, like, we're going to focus on some appreciation? Was there maybe kind of like a timeline of saying, hey, like, cash flow is really, really important? Or some things that, like, maybe market factors that said, hey, look, cash flow is really, if not king, the thing that you should really be looking at first, and then looking at the next two or three things.
Go ahead, Scott.
I mean, Pat was doing this when I met him in 2003. It was the concept of phase planning, of saying you should have risk baskets for your different types of asset classes. I came from the side of the fence that was just buy equities, and you'll grow as much as you can, and it'll have to be enough, right? Part of the revelation to me when I started working with Pat was that when we would put together what we call a phase plan, which is a cash flow where we put together your inflows and your outflows and match them up to the assets that you have to spend, right? Your IRAs, your brokerage accounts. If you have anything like a rental house or anything like that goes into the calculation. But what really got me was we started to be able to show people that they could have a successful retirement only earning 6% or only earning 7% on their overall assets. And what most people were doing is they're coming in and asking to beat the S&P 500 in every year, or they hear that their neighbor was up, so they want to be up that much. When in reality, if you just relaxed and got an 8% average annual return over time, taking way less risk, your agita, or every time you open your portfolio during a bad market performance, you get stressed out and you yell at somebody, right? And so to me, it was the realization that these people don't realize that they're taking more risk than they need to be taking. And the cash flow planning for me was a wake up that if you're delivering a regular cash flow as part of your total return, it's going to be a more stable return to begin with. And as long as you're evaluating those cash flows for consistency, then you're giving yourself, it's almost like having an automatic rate of return to start the year that's positive. And then all you're looking at is, like you said, the correlation of having the right amounts of assets in the right types of asset classes so that no one asset class is ruling your portfolio, is a big part of that. And to me, the eye-opening was people are taking way too much risk. They think they need to be matching the market when they don't need to be.
And what would you say is kind of your allocation, or like where do you like peg the risk of things that are price point dependent for their cash flow versus things that are divorced from that, things that have more of a pegged like payment, maybe like annuities, or more like real estate, which has more of like a rental contract agreement for as far as its cash flow payment, versus something like a dividend paying stock where the price point is the direct corollary to its cash flow. Like, how do you weight those as far as the risk profile?
We rarely ever look for cash flow in equities.
Okay.
To us, it's something that just shouldn't be matched up.
Mm-hmm.
There are some equities that you have to take into account, like if you're saying that it's an MLP, right? Or sometimes you have loan portfolios that trade like stocks, and so sometimes it's not as much price dependent as it is. Is it a good cash flow for that asset class? Is it reasonable to take? And are we taking a risk buying it at this price point? Like you said, we fall much more on the side of we'd rather have cash flow generated from a process, or like you said, lease income, right? Or oil and gas revenue, or a dividend from a multifamily investment or something like that. We try not to rely on the stock side of dividends.
No, that's good. So it's be a fair point to say that would probably be on the higher part of the beta profile, right? That's more what you assign the more risk to is going to be that price point dependent on the underlying asset versus things that have a more contractual, or there's no such thing as a guarantee in anything in life, but more of that kind of fixed stated income, right?
Yeah.
Well, we find that the problems always come up, and you said this earlier. If you go back to 2013 or 14 and bring it on through to 2022 or so, you've never been in a bad market. You've never seen a bad market. It doesn't exist. But when you put these things together, if it's the endowment style portfolio or any portfolio, you better assume that there's going to be at least one bad market in there. And that's why you go for the correlation or non-correlation of assets, because that's going to come when it's most unpredictable. And that's where the client's going to call you up. They very rarely do clients call up and say, "Gee, Pat, you've done such a great job for me. Thanks." But they do call up and say, "What happened? What happened? My money's taking a 15% hit." And you have to educate the client that the markets move both ways. But going back to the systematic risk I was talking about, where the whole market either goes up or down, that risk can be caused by many things. I mean, it could be caused by economic data, can be caused by inflationary data, can be
Caused by a
caused by
tweet nowadays.
the what?
It can be caused by a tweet nowadays.
Oh yeah, oh absolutely. It can be caused by a tweet and natural disasters, etc. All these things. Who would have ever who would have designed a portfolio based on a possible pandemic? Nobody.
Yeah.
And so now our thinking is a little bit broader about what could happen, but we're not going to be ridiculous about it. The pandemic happened, and we went through a nice recovery, so on.
Yeah.
So anyway, I wanted to kind of go over that. That was an excellent question, and that sort of gets to the bottom of how we construct these portfolios.
Mm-hmm.
And it's much more difficult to create a good endowment style portfolio with a client that has, let's say, investable assets of $1 million or less. If somebody has $3 or $4 million, it's so much easier to allocate that than it is for. So we really have to work harder on the smaller portfolios. But the key to any of this is, what is the client spending? It really doesn't matter what you make. What are you spending? That's number one. If you're spending $15,000 a month and your portfolio is worth, I don't know, $600,000, you're going to be in trouble. Maybe not now, but that cash flow will say, okay, you're going to be in trouble in year 12. You're now going to be 73 years old. We need to address something now. So I've just taken you away. Your country club membership has been canceled. Some of these things have got to go.
No, absolutely. And the other part, you kind of bring up the point of, some of these things, and it's important for people to understand, especially if this is new to you, a lot of these different types of investments, to the point that you were making of, it being easier with $1 million. It's not to say the person with $1 million is just better or something. It's the nature of these style of some of these investments, right? Have minimum investments of $50,000. Some, at minimum, most of the time for like Reg D stuff, it's going to be 25 grand is the basement of what they cost per unit. And they can range up there to about 75, and some of them have 100, maybe some of them have $250,000 investable minimum.
Right.
So it's more of the nature of the investment, not necessarily saying that a $1 million client is just so much easier because they have so much more money. It's just practically doing some of these types of investments is just easier. But from that other profile, like some of the other assets we've mentioned, you don't have to have all that money. Again, yeah, insurance isn't the sexiest thing in the world, but there are certainly a lot of interesting products out there. Annuities aren't just your grandmother's investment anymore. There's some cool products out there, especially with some of your what's the word I'm looking for? I just interviewed a guy on annuities.
Some of the hedging in annuities is quite sophisticated.
Equity index and the RILA.
The equity indexing annuities are pretty cool, and they turn over. They can turn over year over year, so it's not like you're locked into a 5 or 10-year annuity contract. So there's some cool stuff out there with stuff that you can get into for almost any price point.
Yep.
But then again, understanding cash flow versus liquidity, and that again is what's going to drive, what are your cash flow needs? If you have that, $300,000-$400,000 and you have a $15,000 a month country club membership, well, maybe you have bigger problems to examine on that profile. But the next point I kind of want to bring up as well is you made the point, Patrick, of it's how much you are bringing in, but it's to the further to that point, it's how much you keep, right? We're next. Well, for us in Florida, because we got wrecked by 2 hurricanes, we have till May 1st, woohoo, to file taxes. But it's how much you keep, and while it's not as the biggest weight of things, you have to keep that in mind when you're doing any type of investing. Because if you make a great cash flow, but that cash flow is taxed at 50%, well, maybe that return that's taxed at, 15 or 20%, that is half the amount, is a better shake, right? You got to figure out where you're going to be paying this. So what are some of the different advantages to, some of these things that are apparent, and what are some things that people, in this kind of concept should kind of watch out for?
Well, yeah, like you said, the efficiency of some of the incomes is a big thing, right? And what structure is it owned by? And we have a lot of clients who have their assets invested in a trust, which has very high tax rates for income, right? And so then you're pursuing alternatives for the efficiency of the income, because real estate is generally going to come with depreciation, where a lot of the incomes, depending on what type of property you're in, can be 90 to 100% tax free. Makes a big difference when you're stacking income inside of a trust. Oil and gas is another one that typically has a better, more efficient income stream. If you're buying it outside of an IRA, you're getting advantages there, either on the income where you're putting it, or the income that you're receiving, or you're getting an upfront deduction on the money that you place or something. That's one of the reasons that we do the phase plan, is because we want to know if we're going to create income from a program, right? Is it going to be stacked on top of how much other income? And is it going to create a tax burden for you? Is it going to put you into the next, marginal tax bracket? And so we have to do that work of understanding the income that we're creating still has to be taxed, even if it's not spent.
Yeah, absolutely. And some of those things too, there's with alternatives, especially when you start looking at things like, let's say debt funds, real estate, and oil and gas, the treatment of the income through those things can be treated wildly different. Like you might get a
Yep.
K1 from all three of those, but oil and gas has a ton of weird like proclivities where even some of that income can help offset ordinary earned income as well,
Yep.
which you don't get in nothing else that I can think of really has that offering to that point. But you might not get but like you might, let's say a debt fund might pay out, but depending on how they're paying out, it might not pay out as interest income. It might pay out as pass through. So you don't get that favorable tax treatment. And you also don't get the depreciation and like cost segregation that you get with a commercial real estate building. So when it comes to alts, again, it's the simplicity of just looking at a cost basis analysis from a traditional stock portfolio is something that bears a lot of understanding, or having competent professionals that can advise you to that effect. Because a lot of people come from the traditional securities world to an outfit like yours, or doing stuff like we do, with the tax advantage accounts, not so much, but it's, a safe assumption that they're, if they're making that transition with their IRA, they're probably doing it personally as well, of understanding just the wild spectrum that can be had on the taxable implications of some of these things. And to your
Mhm.
point as well, again, if you're doing, people love trust, but a lot of people, especially if they're new to it, don't understand that trust income over like was like 1475. Anything over that's taxed at 39 and a half or 39 and a quarter. Like you get hosed on tax rates.
You're
Like
very near the top bracket at like $10,000 of income.
quick, but the key is quickly.
Yeah.
Very, very
Yeah.
quickly. Trust rates gets expensive fast. So, again, it's something, especially when we talk about alts, especially diversified alts, that I think bears at least some explanation, right? That,
Hmm.
especially if you're doing this, just understanding your taxable picture can be extremely favorable, right? It's not, I don't bring this point up to say like, hey, like these things are just going to hammer you in taxes, so you need to be investing tons of money for it to make sense.
Yeah.
They can be very tax efficient, but you need to, understand what these things are, what are your cash flow needs, how much are you paying out in taxes, what does that all kind of mean in that, conglomeration of this strategy that you're employing, because no one wants to pay the government a dime more than their own.
Yeah.
Yeah. Right.
There's also the other thing that there's also structures that are kind of being invented now that are becoming more efficient. ETFs. There's all kinds of interesting products being put together with ETFs. And ETFs are under a different rule of when they rebalance, they don't have to push out the capital gains the same way as a mutual fund does, depending on how they're structured. So, depending on what kind of account you're in and what type of structures are available to you, sometimes it's just look for something innovative that is protecting, a capital gains distribution or something like that.
Yeah, and I mean, I would ask the question too. I think, you know, when it comes to operators of these things, to kind of bring it back a little bit, when you say you're looking at operators, you're saying you're looking a lot at track record. You know, and sometimes, again, this doesn't always hold true, but sometimes the longer track records tend to yield less creativity. They find something that works, they find their core competence, and they do it very well. So the innovation can sometimes be lacking in people that have done something done something for a long time very well, which is fine. If you can do something extremely well for 40 years, that's awesome. But it doesn't always necessarily lead to kind of the innovation aspect. So do you find it like how do you balance that, right? Because you want people to be innovative because innovation is what's going to breed being able to find those consistent returns. Everyone's going to markets get saturated. You got to learn how to navigate, right?
I think risk hides in innovation.
Mhm.
And it's great. That's not a pejorative statement, but if I have a sponsor that can reproduce a process and it's a cookie cutter process, that's really what I'm looking for, because the client sitting across from me doesn't give a hoot about innovation. What that client sitting across from me is looking for is consistency. I need $7,000 a month. I don't need $6,500. I don't want $7,500. I want $7,000 a month, and it cannot vary. And so the sponsor can't come to us and say, "Gee, you know what? We're only going to distribute half of that this month, and we'll pick you up later on in the year," or something like that. We're looking for innovative things, but I want consistency when I have to deliver income. And so the innovation there is not that important to me.
Okay.
Scott, you may have a different
Yeah,
view.
I'd say to me, it comes down to the specific nature of the investment. And to me, like you said, sometimes these longer track records get watered down. I think they get watered down not because of the long track record, but because they're getting general about their investments. Like if a real estate company gets so big, there's certain property types that get left out of their portfolio all of a sudden because they have too much money to place. Right? Think about, or the same is true for these credit funds who they raise ungodly amounts of money and then they need to find a place to put it. And they're making those investments because they have to make those investments, not because they want to make those investments. And so we're a much bigger fan of the specific drill down funds that go to a specific place, right? Like a good example of that for me would be, not to say that you should invest more in credit, right? I'm a big fan of very late stage mortgages, of buying like mortgages it's a 30-year mortgage and you're buying it in its 28th year or the 27th year, where you're probably getting a discount on it. The holder of that mortgage wrote it in the 90s. They didn't refinance throughout all 15 years of zero interest rate policy. They paid their bill through COVID and everything else that we went through. That's a great investment. It's going to get paid off. And the collateral for a mortgage that's in its 28th year is off the charts. The homeowner has like 90% equity plus, right? That's the specificity of that investment is you're protected by how specific it is. You're not protected by the track record or the generality. You're protected by how specific of the dynamics of that investment are. And so I think the innovation comes from doing the same thing and figuring out a really good way to do it on this very specific asset, rather than just saying, I'm going to be in real estate and I'm going to be all over the place. It's a lot easier to pick a segment and master it.
Yeah, and I think also to that point, it's what is the innovation, right? It's like the concept of like doing something new and great, but like I think that might be a bigger risk profile in what you're talking about, but like figuring out a new like tax structure, right? Like knowing how to navigate and provide value with things that come up legislatively, I think is probably probably would be a benefit, if anything, a net neutral on a risk profile standpoint from what you're saying, from that same perspective. Like you don't want to necessarily mess with the underlying like what they're doing, but if they can do the exact same thing and with just getting more understanding and being more efficient with the taxes is provide that 7,500 instead of the 7,000, but at face value, even if you have to go back to the old system, you still get the 7,000. Again, that's what I think I'm kind of hearing from you is it kind of depends on what the innovation is. And I would say most people, most operators, they're going to outsource that, but, making sure that they understand that they need to kind of examine it on a periodic basis is probably where they're going to find those efficiencies.
I'll, one example.
To a degree, the only innovation we care about is lowering the risk and still getting as good or a better return. That's the innovation.
There you go.
Taking less risk to do the same thing.
Well, yeah, I in my entire career, I never found an oil and gas investment that I liked. I didn't like the way it was structured. The payback was over the lifetime of the client almost. So you might think it's strange in Texas that we never had an allocation to oil and gas ever until about 2 years ago, when we found a program that was extremely innovative, very different, and the client could get their money back within 3 to 4 years. And so we found innovation in a business that is well over 100 years old, drilling for oil, bringing up gas, etc. And so we found that blending and that marriage of innovation and predictability. And predictability it's all about predictability. I want a portfolio that has 99% probability of success and predictability of success. And that's what I want to be able to deliver to the client.
No, yeah, that definitely kind of I think is a good capstone to what we've been talking about is that kind of concept. And it's been really interesting to kind of look at the perspective that y'all are taking in how you're so focused on cash flow over a lot of different stuff that, at least from my experience, isn't like my clients don't always necessarily look at it as that broad, right? It's a little bit more hyper focused on the industry. When you can create that cash flow with different assets in the alternative space that will give you that diversity that everyone that's taken investment 101 has this, like the more diverse you can be, throw that dart, put the stock ticker sheet up and just throw a dart at it. That's how you create diversity. It's that you can really kind of glean that diversity. But the key factors in are figuring out how to do it safely. And from your perspective, it's mainly looking at the operators, which again, I wholly agree with. I don't really think that there's a better piece of like, easily identifiable good, I always don't like to say advice, but like easily identifiable best practice, if you will, for any investment is to look at who's stewarding your capital, right? If you're going to turn it over to someone, understand their competencies and their track record and what they're doing is paramount.
Mm-hmm.
Exactly.
Absolutely. Well, are you all in alignment?
Yeah.
Yeah, exactly. Because if you're misaligned, I mean, you could agree exactly on what they're doing, but if they're like, we're really good at getting blood diamonds out of Africa. It's like, maybe, okay. But it's like, make sure that it aligns with your values and what you want to do. And, again, oil and gas isn't for everyone, right? Like you may be fundamentally opposed to that. And you have to take that into consideration. Be okay with where your money's coming from.
That's right.
If you don't like investing in certain sectors, like keep that in mind. Like that is something to consider. So,
and we've gotten into discussions like that before. We've had, I saw a piece and read a lot about how manufactured housing is really a big investment right now. But to me, it's it's some of the most disadvantaged people live in those manufactured housing. Do I really want to participate in an investment that's trying to maximize my profit off the backs of some of the most, unfortunate people? That's a decision that you have to make.
Yeah, and it's the interesting thing too, though, and that also goes to operations is, one of my big things that I really like is manufactured and mobile homes, but from the perspective of it's one of the last bastions of affordable housing.
Yeah.
They're not building affordable apartments for people. right? They're not building the skyscrapers, and the new square footage is being created is not in that. But the people that are on a fixed income or need that available affordable housing, I mean, we're still over 400,000 for a single family home in the U.S. I mean, certain markets certainly are cheaper, but especially the parts of Florida that we live in, I have a lot of clients and investors that I know that are, a force for good in that market. They buy these things, they rehab them, and they turn them into nice dwellings for people, right? Some of them syndicated, some of them operate on that principle. So like, again, understanding the operational principle, that can go the same thing for an apartment building too. I think the market's probably a little bit more rife on the manufactured home space for that kind of abuse to maybe happen. But again, that just really kind of goes to show it's like aligning yourself with the values of what's happening and understanding there's a spectrum to all these investments, right? Oil and gas companies can be run extremely well and extremely green to the point that you're still pulling oil out of the ground, right? Again, just making sure that you align yourself, I think, is something that you shouldn't discount as an investor, right? Chase that cash flow, but make sure you're good and okay with where that cash flow is coming from, because everyone wants to sleep at night, right?
Yeah, exactly.
That's our job at the end of the night, is to help you sleep better.
I think that's a great place for us to end this off with. Well, again, I really appreciate you both being on with us. If people want to reach out and learn more about kind of your services and how you can set up these kind of endowment style investments, what's the best way for them to reach out to both of y'all?
Yeah, they can always look us up online with whitestonewm.com, as in whitestonewealthmanagement.com. They can give us a call and chat with us, 210-341-1515. And we're located in San Antonio, but we go all over the place. We go to Denver, we go to New York, we go to California. We're everywhere. So we're happy to hear from anyone.
Fantastic. Well, again, I really appreciate you both being on. The most valuable asset we all have is our time, because we can't make any more of it. No matter how good we are at investing, we all have a finite amount of it. So thanks for taking part of your afternoon to chat with our listening audience. We really appreciate it. My name is Alex Perny. As always, this has been the Alternative Investing Advantage podcast. Thanks for joining with us, and we'll see you on the next one.
Thanks, Alex.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.